Eastern European markets have been strong this year, up around 30%, and one of the biggest drivers has been shift in the global capital flows. Investors are diversifying away from the US and looking for new growth stories in Europe and across emerging markets. And within this global reallocation, Eastern Europe stands out as best of the both, the sweet spot where you can find both higher growth and lower valuations. So let's start from the growth story. And take Poland, for example. Over the last 2 decades, Polish economy has grown more than 5 times. That's compared to Sweden growing just about 2 times. However, the Polish stock market has not really reflected that journey yet. But this disconnect is starting to close now, with more market-friendly government in place, unlocking EU funds, massive infrastructure investments, defense spending, and the recovery of the consumer. So fundamentals are now in place for Poland and for Polish equity market to finally catch up with the economy. And this is not only Poland. Across the region, we see Greece, Slovenia, Romania, Baltic states, and other Central European countries expected to grow stronger than Western Europe. Corporate earnings are also expanding on the back of this. IMF expects Eastern Europe to outpace the developed markets for years ahead. Yet at the same time, valuations remain highly attractive. In many cases, these markets still are trading at 30 to 50% discounts compared to Western Europe or emerging markets. That means investors can buy into this high growth at a bargain. But there's also unique catalysts coming up, and these could redefine the region and especially potential for the peace in Ukraine. Markets are already currently pricing over 70% probability of the Ukrainian peace deal. If that happens, it lowers the risk premium of the region, lowers the energy prices, lowers inflation, but most importantly, unlocks one of the largest reconstruction efforts of our lifetime. World Bank estimates rebuilding Ukraine will require nearly $500 billion over the next decade. And who will benefit from this? And these are the neighboring countries with the scale and capacity, such as Poland, Turkey, Romania, Baltic states, Greece. A lot of efforts will be required. Construction companies, banks, and other sectors, they are all poised to participate in this rebuild, and we in our funds are positioned accordingly. Meanwhile, defense spending is also reshaping the landscape. Poland is emerging now as the 4th largest military power in Europe, committing the highest rate of 5% of GDP to its defense spending. The spending is not about only security, it's fueling investments in technology, construction, infrastructure, creating powerful second-order effects across the economy. And don't overlook Greece. Once seen as a crisis story, now Greece is reborn as one of Europe's growth leaders, with strong EU fund absorption, booming tourism, banks cleaned up and recapitalized, and investment-grade ratings regained. Greece is firmly now on track to be upgraded back to the developed market status in about a couple of years, and we expect the stock market to perform on this journey back to developed markets. So when we step back, the picture is quite clear. Eastern Europe today offers a rare combination of high growth, low valuations, and transformational catalysts. As a region where macroeconomic fundamentals, political, geopolitical momentum, and global flows are finally aligned. At East Capital, we've been investing in Eastern Europe for nearly 3 decades. We know the companies, we know the cycles. We've built the process to capture the best opportunities at the same time managing the risks, which has delivered significant alpha to our clients. And right now, with valuations deeply at a discount and growth accelerating, geopolitics improving, we believe this is one of the most compelling entry points in years.